Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. As a dedicated value investor, I'm going to say something now that might sound odd and strange to many of you, especially those of you who've been looking at the stock market the last several days. I love markets like this. As a value investor, I crave markets like this because markets like this are times when I see nothing but opportunity where most people see nothing but risk. And I'll try to explain that in this video. And I'll try to talk about what's really going on, what the impact of things like tariffs are really going to be. In other words, what I want to do, I feel very strongly that what is now so-called mainstream media, the NBCs, the ABCs, the CNNs, etc., they tend to be left-wing leaning. That's not a value judgment. I think that's a factual statement. But there are two sides to every story. And with this video, I plan to give, or I'm going to try to give you at least both sides of the story and let you make up your own mind. I want to see both sides of the story. So I always look for alternative sources of information so I can understand. So today's video is going to be titled Tariffs, Economic Destruction, or Short-Term Pain Leading to Long-Term Gain. So let's go ahead and get into the video. So what are tariffs? Are they economic destruction or are they short-term gain leading to long-term pain? To listen to all the pundits now and to look at the stock market, Donald Trump's policies with tariffs are destroying the economy and destroying the stock market. We've lost all this money in the stock market. But there's some nuances here that really need to be understood. So let's go ahead and evaluate, first of all, and take a look at the stock market from a value investor's point of view as it relates to the SPY, or the Standard & Poor's 500 ETF. So here we are with the fast graph, and there are several things I want to go over on this graph, and I'm going to warn you, or forewarn you, that I'm going to probably do a pretty long video here, okay, because I do feel this is a very important subject. I know people are desperately worried about their financial health, the markets, etc. And so let me start by looking at the S&P 500 ETF Trust from a value investor's point of view. Now, what I have on here is I have actually three important lines. There's four. This is the dividend of the S&P. But these are three important lines. Well, two right now. I'm going to put the third one on in a minute, that are really valuation oriented. I want you to see that. The first one is the orange line, which is the theoretical fair value, or what I would call the conservative fair value, which would be a 15 PE ratio, which would indicate also a 6.67% earnings yield. A point that I think is often missed and people don't understand is when stock values get above that 15 PE, or that 6.5 to 7% earnings yield, we start getting lower earning yields, even after this significant correction. And let's put that into perspective here. What the market's corrected since February 14th to yesterday's close, the market has fallen 17%, okay? And that's just the growth of the market. Now, if you annualize that, it's pretty dire. It's 73%. If it would do that every month or quarter or 2 months, whatever it is, it would be a very large number. But in reality, it's only fallen 17%. Now, it's fallen from a blended PE of approximately 25.56, down to a blended PE of 20.1. Okay, but we have had this drop in value. But here's the point. If we are measuring valuation, during this time frame, the historical normal PE, which is the blue line on this graph, has been 19.8. But let's evaluate what that means. That means if the price is touching this blue line, it's a PE of 19.8. Now you can see coming into the recession of 08 and 09, it was trading at PEs approximating that 20 multiple. 20, 21, etc., and even got into the 24 or 25 like it did before it started falling here just recently. Then, now this is important, I'm going to refer to this later, we ended up coming into the recession, we had 2 negative years of earnings growth. Okay, we had a 24% drop in earnings from 06 to 07 and a 26% drop from 07 to 08. So the earnings fell 24% and then 26%. Now, the stock price also followed suit. The stock price fell during this period of time from almost peak to trough, or at least it fell by about 53%, which is pretty close to adding up these two numbers, if you follow me. All right, but here's the point. In this case, we actually had fundamental deterioration along with stock price, and the stock price simply followed that economic deterioration, and it fell from being technically overvalued, but as the economy was deteriorating, it became undervalued. Then, as the S&P 500's earnings began to recover, as you can see the orange line here, earnings grew 33%, then 40%, then 21%. We saw stock prices starting to follow that, and this was what I consider to be, as a value investor, the great opportunity to invest in the market or in stocks in general. Remember, I believe it's a market of stocks, not a stock market, as I've discussed many times. But this was a period of time where stocks in general were trading at very attractive valuations. Now, that's a conservative level. Now, you can also look at this graph and recognize that a 19 or 20 PE, this says 19.8, we'll just round that to 20. So the blue line is roughly a 20 PE. All right, you can see that the market has traded above the 15 valuation most of the time in this last 20 years. So this is the aggressive value, or the normal or market PE that the market likes to put on the market itself. So in other words, you can use this as a high valuation threshold. You can look at the orange line as a low valuation threshold. All right, so we did have a period of wonderful investment opportunity, and from 2010 really all the way to 2016, where we could have bought stocks technically cheap or undervalued or in value at least. Then we had a period where it stayed pretty much around value, and I want you to notice that when you get a strong dip in the market, how it recovers. Even during COVID, which is this gray area, we had a strong drop in the market and then a super strong recovery. Earnings determine market price in the long run, but emotions determine market price in the short run. And those emotions are fear and greed. Okay, so as I evaluate looking at the market here, certainly for the last 4 or 5 years, we have a period of very high valuations, except for what happened in 2022. We did get a period where stock prices fell close to reasonable valuations again. Okay, but then just coming into last year, 2024, we had the market really rally in price, but we also had good earnings growth during this period of time. But it wasn't anything spectacular. It was just solid earnings growth. But the market traded at valuations that, in a value investor's perspective, simply were unjustified. Now, I would like to see the market fall more than it has already. And I know that's heresy to many people. But as a value investor, I want to be able to buy stocks when they're safe, when they represent ability to participate in the companies I'm investing in, their full measure of their growth. And I can't do that when stocks are overvalued, because eventually prices are going to revert to the mean. And you can see that over and over again. So here we've had talks of tariffs from the Trump administration, and we've had a mainstream media that's basically spinning the yarn that tariffs are going to destroy the country. And we're also talking about that in terms of going back to the Smoot-Hawley, I guess it was, law in 1930, that where tariffs came in, and the tariffs they claim was what caused the Great Recession. I'm going to address that because that's not really a fair statement. They did contribute to the Great Depression, but they weren't the cause of the Great Depression. And there were certainly mitigating factors, and we certainly have a different kind of economy today than we did back in 1930, and that's critically important in this. But anyway, looking at valuations recently, I want to look at this from another perspective. So we've added a line, the ability to draw a line on a fast graph called the current valuation. So that line will cut through right here. The current blended PE is 20.78. So when I draw that current valuation line, you can see it goes across here and then goes back. So I'm going to take the normal PE off. And now we're just going to look at this from a standpoint, even after this large correction, is the market trading at a valuation that is typically low or typically high or in the middle, or what is it? My argument is it's still typically very high. There have only been a couple of times, a little bit coming into the recession, but as the market was correcting itself, We saw it trading a little bit coming into COVID, a little bit in 2018. We saw the year 2021 and most of 2020 actually where we had valuations above the current valuation. And of course, those led to big drops in the market. We have this high valuation we saw in 2024, and the valuation itself is a major contributor to the market decline. But I think the market still has more to go. I think from an aggressive point of view, the market could drop down to this blue line, but I think it actually belongs on this line or something closer. So my point is, I don't think it's necessarily over yet, but they don't ring the bell at the top or the bottom of the market. I just want to say it differently. I don't consider the market cheap yet. I still consider the market fully valued to slightly overvalued, if not massively overvalued, depending on whether you think the market's going to eventually move back to the orange line like it has in past. If it would fall essentially to the orange line now, at least by the end of the year, let's say, we could see another 20% drop in valuations. Whether that's going to happen or not, time will tell. But the main point I want to make is, and that I'm trying to make is, that measuring the market from a value investor's perspective, it's not cheap. Now, I can look at operating cash flow and use it as a valuation reference. And I do want you to notice when you look at operating cash flow, the market has traditionally sold even at 8 or 9 times cash flow. It's currently now trading at almost 16 times operating cash flow, but it does look like it might be coming into fair value. If I look at it from a free cash flow to equity point of view, once again, we see that the market looks very highly valued relative to historical norms. I'm simply looking at every other valuation measurement or metric that investors tend to utilize or look at. I look at EBITDA, and EBITDA, the market still looks very fully valued based on EBITDA. If I look at net income or EBIT, if you will, then I get the same perspective. I get a market that's moving towards value, but is still technically overvalued. Again, I've got the black line on here. Now, if I put the normal PE on, there isn't one for EBIT and EBIT. I just want to make that clear with fast graphs. This is the normal price to EBIT in this case. And then let's even look at it from a sales perspective. If I look at the S&P 500 from a sales perspective, it's still trading at a very high price to sales ratio of 2.69. Its fair value ratio is 2.03, which would be down here. So what does that mean in terms of what's the risk? If it would fall back to a more normal price to sales, we'd see another 20% drop in the market. And that range of potential loss seems to come up when I look at all these different valuations here. So the point is, number one, that the most important point, and I'm going to go back to operating earnings here because we're just going to focus on that, is right now, in all of that I said about where the price is, I want you to note that we're still looking at the earnings being expected to grow of the S&P 500 rather substantially over the next 2 or 3 years. Okay, but let's go to the forecasting calculator and let's go to the custom calculator. And let's assume that tariffs are the destructive force that many, especially on the left, and the anti-Trumpers, the ones who do not like President Trump and are against all his policies. If we look at what they're looking at, if I look at, for example, earnings of the S&P, let's say falling by 5%, in other words, not growing. If I look here at estimates, the estimates are expected to grow at almost 12%. If I use the normal multiple for the last 5 years, which is a 23 multiple, which is higher than anything I've shown you so far. But if I look at that 18 multiple, that would be this orange line. But this would be, if the market did grow at 12%, then the market could even be argued that it's undervalued now. But when I go back to the custom calculator, if these tariffs were really going to destroy our economy and cause earnings of the S&P to, let's say, drop by 5%, then I'd have a potential real problem with what my rate of return could be over the next 4 or 5 years. Let's go back historically and let's look at what happened in 2007 and 2008, where the market fell 24 and 26%. So let's go now to the forecasting graph, and let's do a what-if scenario. Let's go to the custom graph again, and let's do a what-if scenario. What if the market actually fell by roughly 25%? Now we would have a real problem in the market. So if you believe the economy is potentially going to be destroyed by tariffs, to that extent, then you would have, I think, the right to be afraid. Because if we're looking at this, it possibly happen over the next 5 years, you could lose 90% roughly of your money over the next 5 years. Okay, but if the market continues to go as current forecasts sit, then you stand to make money in the market. And if you use the normal multiple, you could still make a very nice return, 15 to 20% in the market. Okay, so that's what's going on with tariffs. Now, the real question is, I want to hear both sides of the story. Is this short-term pain that we're experiencing so far actually going to lead to long-term gain? Now, the Trump administration and its advisors and supporters all believe that we're going to be entering a golden age of economic results. In other words, that we think these tariffs are going to be real helpful. But no one's talked about what tariffs have accomplished from that perspective. They only talked about how it caused a recession, the Great Depression of 33, and how it contributed to it. It didn't cause it, by the way, but it contributed to it. And it caused other depressions. Why is it tariffs today going to cause a depression again? Well, let's look at some facts here that you might find interesting. So when you're answering the question, are we looking at economic destruction, or are we just simply looking at a short-term pain, meaning the stock market is correcting? And by the way, it's been a catalyst to bring it from overvaluation towards fair valuation, or is this going to really lead to strong long-term gains? So let's examine that. Let's look at what's happening as a result of these tariffs that's already happening. Now, we see companies reshoring production back to the automotive sector. I'm going to cover this a little bit more, and I have a link to a document that you can look at the bottom of this video and see that talks about the history of tariffs and the history of our manufacturing. In the 30s, we were a manufacturing powerhouse. More recently, most manufacturing has moved overseas to places like China and Southeast Asia, Vietnam, Mexico, of course, and Canada even. All right, so the question is, are we going to bring any of that manufacturing back to the country? Is it happening? Well, as it so be it, we've already seen a great deal happening with that. For example, Hyundai announced a $21 billion in U.S. investments, including a $5.8 billion plant in Louisiana focused on electric vehicles, which are obviously less dependent on complex supply chains compared to gas vehicles. Ford is investing in EV as well, and battery production facilities such as Ford Blue Oval City in Tennessee. Stellantis has temporarily suspended operations in Mexico and Canada due to the tariffs, leading to layoffs in Michigan and Indiana. Taiwan Semiconductor is building semiconductor fabs in Arizona as part of the CHIPS Act initiative, and the semiconductor industry itself expects $650 billion in investments over the next decade for reshoring efforts, representing 28% of global capital outlays. That's a huge number. The Samsung Semiconductor is investing heavily in Texas facilities under the CHIPS Act. In other words, manufacturing is coming back. ABPT Limited has invested $14 billion in U.S. facilities and continues expanding operations domestically. Now, that's not all tariffs, because obviously that started in 2010, but they're aggressively going on. Steel Dynamics is benefiting from steel tariffs with increased domestic production and higher steel prices. So the steel and aluminum industries are participating as well. Consumer Electric, Apple, has not committed to large-scale reshoring. It has produced some high-end products like the Mask Pro in Texas and pledged $500 billion for acquisitions of U.S.-made parts and chips. So they're bringing some business back to America. The pharmaceutical sector is expected to reshore production due to supply chain vulnerabilities exposed during the COVID-19. Since President Trump took office, companies have announced reshoring investments totaling $1.4 trillion, potentially creating around 200,000 jobs. The semiconductor industry alone accounts for $650 billion of this figure over the next decade. So in other words, the tariffs are originally causing fear, and the market is being sold off, which was a catalyst that I believe is cleansing the market that needed to be done. But we're also looking at major impacts on our economy that shouldn't cause the earnings of the S&P 500 to collapse. In fact, they could even grow faster than what are currently being expected. Now, key drivers behind are the tariffs on imports, 25% on cars, steel, aluminum, 10% baseline on all imports, Legislative incentives are contributing, like the CHIPS Act and the Inflation Reduction Act. Supply chain vulnerabilities are highlighted by global production such as the pandemic, and consumer preference for made-in-USA products and corporate sustainability goals. So reshoring is actually gaining momentum, partly motivated by, or let's say enhanced by, the tariffs, but remains a very complex issue due to workforce challenges, infrastructure needs, and higher domestic costs compared to overseas production. Keep one thing in mind: what the Trump administration is alleging is that we've been unfairly taken advantage of. Countries like China don't pay their labor anywhere near what we have to, and therefore can flood our markets with cheap goods, and our U.S. companies can't compete. They're trying to, in the Make America Great Again movement, the idea is to make America a competitive force in manufacturing worldwide. Now, going back to review this, the automotive sector, Honda plans to build its next generation Civic Hybrid in Indiana instead of Mexico to avoid tariffs. Hyundai announced further localization of production, including hybrid vehicle manufacturing and its new factory in Georgia. Volkswagen is considering setting up production sites in the U.S. for high-end Audi and Porsche brands to mitigate tariff impacts. Volvo, to continue, it may move some production to the U.S. depending on tariff developments. Stellantis, Chrysler, Jeep, Dodge temporarily suspended operations in Mexico and Canada to build a new midsize pickup truck in Belvidere, Illinois. Mercedes is contemplating moving production of certain models to the U.S., including luxury SUVs and sedans, which of course are big sellers. Technology and electronic companies, Apple plans to produce AI servers domestically and add 20,000 employees in response to tariffs on goods imported from China. Samsung is considering relocating dryer manufacturing from Mexico to its South Carolina plant. Inventec is evaluating locations for U.S.-based investments, particularly in Texas, for AI service production. Continuing with technology and electronics, Compo Electronics is exploring expansion in the U.S., with Texas as a potential location for laptop manufacturing. And the giant LG Electronics is considering moving refrigerator manufacturing from Mexico to its Tennessee factory, which already produces washing machines and dryers. So tariffs is bringing reshoring back into the United States in rather large numbers. In industrial equipment, Rockwell Automation, which is positioned as a leader in refreshing efforts for U.S. factory automation due to increased domestic manufacturing investments. Steel Dynamics is benefiting from steel tariffs, leading to increased domestic production and higher steel prices. LVMH, luxury goods, is exploring options to expand production, particularly for their luxury goods. Essity is considering moving hygiene product and tissue manufacturing from Mexico and Canada to the United States. Campari Group is assessing opportunities for expanding production in the U.S. This is obviously the spirits industry. And so bottom line is, the key observations that I've made from doing my research on this is that many companies are reshoring due to the tariffs on imported vehicles and components effective May of this year, as well as broader tariffs on goods from China. The reshoring trend is concentrating among industries such as automotive, electronics, industrial equipment, and consumer goods. Now, while specific dollar volumes tied directly to these announcements are not always disclosed, broader industry estimates do suggest significant investment driven by tariff policies. For example, reshoring initiatives supported by legislation like the CHIPS Act have led to semiconductor companies like TSMC and Samsung to announce $650 billion in investments over the next decade. Now, keep in mind, this means jobs, but you also have to be realistic. It's going to take time for these factories to be built. It's going to take time for these jobs to basically issue paychecks and have their employees spending their money. So that's why I say short-term pain for long-term gain. Major companies expanding U.S. operations is obviously technology and semiconductors. Apple's already committed $500 billion over the next 4 years to expand facilities in states like Texas, California, and Michigan. They plan to include a new 250,000 square foot AI server manufacturing facility in Houston, Texas, expecting to create thousands of jobs. Taiwan Semiconductor announced an additional $100 billion investment in U.S. operations, bringing its total commitment to $165 billion. including 3 new fabrication plants, 2 advanced packaging facilities, and a major R&D center in Arizona. NVIDIA, or the AI giant, has committed hundreds of billions of dollars to expand U.S.-based manufacturing for AI and semiconductor. And in pharmaceuticals, Eli Lilly announced a $27 billion investment in domestic manufacturing, including a $1 billion facility in North Carolina. Hyundai pledged $20 billion for U.S. operations, including a $5.8 billion new steel plant in Louisiana and hybrid vehicle production at its Georgia facility. Stellantis is investing $5 billion to reopen a manufacturing plant in Illinois and increase domestic vehicle production. Honda decided to produce its next generation, as I already said, Civic hybrid in Indiana instead of Mexico to avoid tariffs. Volkswagen, again, is shifting production of high-end Audi and Porsche models to U.S. This is a recap of what I said earlier. Rolls-Royce is expanding its U.S.-based operations with increased hiring, more jobs, more production in the U.S. Johnson & Johnson have committed $55 billion to expand U.S. manufacturing, including 4 new facilities and significant R&D investment. Merck's already announced an $8 billion investment in U.S. operations after opening a $1 billion facility in North Carolina. Clarios unveiled a $6 billion plan to expand advanced battery production and critical minerals processing. GE Aerospace now is investing $1 billion across 16 states to strengthen its supply chain and create 5,000 jobs. Siemens announced a $285 million investment in U.S. manufacturing and AI data centers, creating over 900 jobs. Daymac Properties is investing $20 billion to build data centers across multiple states like Arizona and Ohio. CMA has committed $20 billion to expand shipping and logistics infrastructure, creating 10,000 jobs. So the bottom line is these key trends, these expansions are part of broader reshoring efforts influenced by tariffs on imports from countries like China. Investments span diverse industries like semiconductors, automotive, pharmaceutical, energy, and technology, and many of these companies are levering government incentives like the CHIPS Act to support domestic manufacturing. These announcements highlight a growing trend of significant foreign direct investment and domestic expansion aimed at boosting the U.S. economy while reducing reliance on global supply chains. The investments tied to reshoring and expanding U.S. operations are expected to have significant impacts on local economies and job markets. Now, next are the key ways these initiatives will affect communities. But before I go there, I want to point out you see very, very little of this mentioned in places like the Wall Street Journal or any of the financial sites or magazines. All they talk about is tariffs are causing the market to go down, scaring people. So the economic impacts of all this, job creation, it's already brought back 1.1 million jobs with manufacturing and foreign direct investment contributing significantly. Every manufacturing job created generates up to 7 additional jobs in supporting industries such as logistics, construction, retail, and professional service. I think that's very important and misunderstood. For example, Caterpillar's reshoring efforts in Georgia and Texas created jobs while boosting regional economies. Infrastructure development. They're building new factories or expanding existing ones, driving demand for local construction, utilities, and real estate. Investments in infrastructure also improve transportation networks and supply chain logistics, benefiting broader economic systems. Economic growth. Increased manufacturing contributes directly to GDP growth. And productivity is what GDP is always about. And wealth, in my opinion, is always about how productive the country is. And what we're doing is we had eventually moved to almost a services economy and a consumer-driven economy. And this has given us an opportunity, perhaps, moving back to becoming a manufacturing and a productive economy again. And again, that's particularly in regions reliant on industrial production. Reshoring initiatives stimulate local economies by reducing unemployment and increasing incomes. Community revitalization. Reshoring fosters interconnected local economies by engaging regional suppliers and service providers, leading to improved community facilities, education opportunities, and the overall quality of life. Diverse employment opportunities. Reshoring creates a range of jobs across skill levels, from production workers to managers and supervisors. For example, a typical reshoring initiative might create hundreds of positions in manufacturing roles alongside direct jobs in logistics and retail. Skill development. Investments often include workplace development programs that advance skills in advanced manufacturing technologies like automation and AI. Companies investing in cutting-edge technologies foster innovation while creating high-skill positions that improve long-term employability. Challenges from automation. While automation increases labor productivity and facilitates reshoring, it may displace low-skilled workers, potentially leading to wage inequality and reduced bargaining power. In other words, everything is not peaches and cream here. Localized benefits from regional impacts, localized benefits. Regions with specialized industries or strong infrastructure see the greatest benefit from reshoring. For example, semiconductor plants in Arizona or EV battery factories in Georgia are revitalizing local economies. States with robust transportation networks or proximity to ports also gain competitive advantage as reshoring companies prioritize efficient supply chains. Now, the multiplier effect is very important. The ripple effects of reshoring extend beyond direct employment. It stimulates demand for housing, retail services, educational facilities, and healthcare systems in affected areas. So the long-term outlook from tariffs initiating reshoring are transforming the U.S. economy by strengthening supply chains, fostering innovation, and reducing reliance on overseas production. While these initiatives create substantial opportunities for local opportunities and job markets, challenges such as automation-driven displacement must be addressed to ensure equitable growth across regions and industries. Anyway, that's my look at tariffs. What I'm really concerned about here is not who's right or wrong. I think it's too early to tell, for one thing. So all these headlines and all this market turmoil that we've seen, I believe is basically, first of all, an emotional reaction. Second of all, I don't necessarily consider it an overreaction because I do think markets are high, as I showed when I was going through the S&P 500. But what I will say is a very strong possibility that this short-term pain we're going through is going to lead to a golden era of economic prosperity in the United States and be a great benefit for America. So all this negative press that's going on needs to be balanced. I wish I could hear both sides of the story from the mainstream media, but alas, I'm only hearing one. My goal with this video was to at least give you some insights into the other side of the story, the prosperity that all this tariff stuff that's causing some turmoil in the markets right now could bring to everything, including the stock markets, over the longer run. Anyway, this has been Chuck Carnevale, aka Mr. Valuation. As a value investor, I'm enjoying the fact that the markets are getting a cleansing. I'm looking forward to the opportunity to buy a lot of great companies that are coming into valuation. I will be expanding my view. I'll be looking at the S&P 500 constituents, the Russell 1000, the Dow Jones. I'll be looking for value everywhere I can find it as a result of this happening. And I think that's what investors should be focused on. I think you should look at this more like opportunity, not crisis. And that's my opinion. And I hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to our channel, and take a look at subscribing to Fast Graphs because it can really help you be a smarter, more informed investor in the long run. Thanks for watching.